Bitcoin could certainly go as high as 90K before the end of the year is through. If you take a look at Bitcoin's correlation with global M2 money supply, obviously not the best gauge for money supply, but certainly one of the more popular measures of it, it seems that Bitcoin lags behind M2 by about 70 days. And if you overlay both of them with one another, global M2 has really taken off like a rocket ship. And if you extrapolate that out, you lag Bitcoin behind by about 70 days, you're looking at a price target of about $90,000 before the end of the year.
The supply shift is crucial as it prepares Bitcoin for its next bull market. Joe highlights that historically, Bitcoin has entered strong bull markets following consolidation phases like the one we're currently witnessing. With the 6-month post-halving mark approaching and Bitcoin's cyclical nature favoring Q4 as a period of strong performance, the stage is set for a potential rally. October and November have historically been among the best months for Bitcoin, driven by increasing liquidity and a favorable global economic backdrop. Global liquidity, a measure of the capacity of balance sheets, continues to rise. The issuance of debt and the need for institutions to purchase this debt is expanding liquidity across financial markets. More liquidity means more capital flowing into risk assets, including Bitcoin. With global central banks cutting rates and balance sheets expanding, Joe predicts that risk assets will have an excellent Q4, with Bitcoin potentially reaching as high as $90,000 by the end of the year.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Bitcoin and crypto are, of course, macro assets. They're influenced by the global macroeconomy, the economic landscape, and other assets too. But they also have their own native factors that cause them to rise and fall, such as earlier this year in April, Bitcoin's supply schedule was cut in half. And so rather than 6.125, now 3.125 Bitcoin are being issued every 10 minutes. So that 50% reduction has an impact on Bitcoin's price inevitably. If demand stays constant and supply remains constrained, just basic supply and demand 101, the equilibrium price has to rise. And so typically after a halving, we see Bitcoin's price surge roughly 6 months after the supply schedule decrease takes effect. And now we are 6 months away from the halving. We're approaching the 6-month mark. And so Bitcoin has its own native reasons for why it chops around so much. But a lot of what has happened over the last 6 months, what has characterized these kind of volatile swings up and down, this really boring but choppy consolidation, has been a shift from short-term holders to long-term holders. And what I mean by that is everybody who has a Bitcoin that is less than 3 months old is considered a short-term holder. These holders are very prominent during bull markets. Think about this, when the S&P 500 is rallying and grandma calls you and asks if it's time to get in, that's an example of a short-term holder. Or somebody who you're talking to at the water cooler during work and they ask you about whether they should buy X stock or Y stock, that's a short-term holder. These kind of flighty participants that enter into a bull market because of the euphoria and mania associated with it. That's what drove Bitcoin to its all-time highs the first time around $74,000. That was driven by short-term holders coming into the market and holding more of that Bitcoin supply. Over the last 7 months now, what we've seen since early March, when Bitcoin actually hit this all-time high, is a redistribution from short-term holders to long-term holders, both as short-term holders sell to those longer-term holders that are older than 3 months, who are going to hold their Bitcoin for a very long time, but also coins that are growing up and aging from 3 months to older than 3 months. And so what this means is that this consolidation period has basically been a supply shift from more flighty Bitcoin holders to Bitcoin holders who are more price inelastic and will hold for the long run. So even though it's been choppy, even though it's been boring, it's very healthy because it's building out a strong base for Bitcoin to rocket from as we go onto this bull market continuation, which is in all likelihood going to happen in Q4, given where global liquidity is trending, given the global easing cycle, and Bitcoin's own cyclicality with October and November being two of the best months for the asset. As long as these conditions hold that I just discussed, the global easing cycle being underway, monetary liquidity global liquidity continuing to expand, and the U.S. economy remaining strong and robust and resilient, then I think Bitcoin could certainly go as high as 90K before the end of the year is through. If you take a look at Bitcoin's correlation with global M2 money supply, obviously not the best gauge for money supply, but certainly one of the more popular measures of it, it seems that Bitcoin lags behind M2 by about 70 days. And if you overlay both of them with one another, global M2 is really taken off like a rocket ship. And if you extrapolate that out, you lag Bitcoin behind by about 70 days, you're looking at a price target of about $90,000 before the end of the year. Now, of course, not financial advice, and there are a great deal of other factors that play into it, but I think the extremely favorable macro backdrop coupled with Bitcoin's own native strength, I think you see Bitcoin rally very hard into Q4. If the economy can remain robust, that means the reaction to the Fed's rate cuts from risk markets will be a positive one. Look, every time we've seen the Fed cut in response to economic downturn, risk assets hate it. They start selling off. You start to see a flight to safety. Treasury yields come down as people pile into the bond market and out of risk assets. Bitcoin and other risk assets don't like that. So the first thing I'm looking for is to make sure that the strength in the economy can remain high. The second thing I'm looking at is the global easing cycle. Now, more than 60% of global central banks are easing. And in fact, the amount of basis points in rate cuts that are happening now is at the same level it was during the Great Recession. And so the economy, the global economy, is still in expansion, but we are cutting at the same pace as we were the last time we had a massive global recession. That's a very good signal to me. We're cutting while the economy is already in expansion mode. Financial conditions are loosening from already loose levels. And so that tells me, again, it's off to the races for risk assets. And the very third thing is global liquidity. So we're seeing global liquidity, which is the capacity of capital, balance sheet capacity, rise. This is balance sheet capacity on the United States government's balance sheet, as well as private balance sheets too. One of the big reasons this is rising is because of the pace of debt issuance, not just from the United States, but from other G7, G10, G20 countries. We are raising and issuing more and more debt than we ever have before. That debt needs to be purchased by somebody. It's purchased by private banks. And of course, some of it at the margin is taken in by the Fed. That expands the capacity of balance sheets because more collateral means more lending capacity. And so ultimately, that causes global liquidity to rise, and that causes risk assets to do very well. And so not only are central banks cutting rates, but balance sheets are expanding, and the US economy and other global economies, barring China and barring Japan, who has its own economic struggles, are in expansion mode. Those are the three things that I'm looking at that tell me Q4 is going to be excellent for risk assets. And of course, Bitcoin being a very highly sensitive, high beta risk asset stands to do extremely well heading into Q4 if all those conditions remain intact.
Joe believes that over time, as Bitcoin's market cap grows and approaches that of gold, it will begin to trade more like the hedge against monetary debasement and geopolitical risk that it was designed to be. But for now, Bitcoin remains a risk asset, highly sensitive to global economic conditions. Joe outlines several risks that could impact Bitcoin's performance. One potential risk is that further escalations in geopolitical tensions could drive investors to sell Bitcoin in favor of safer assets like gold or U.S. Treasuries. However, he also sees a second-order effect, where further monetary easing and capital inflows into the U.S. could support risk assets, including Bitcoin, in the long run.
But there's always a risk that people sell Bitcoin in order to jump into other more safe, traditionally safer investments. Bitcoin, of course, you and I understand it as kind of this apex risk-off asset. It's absolutely scarce. It's geopolitically neutral. So honestly, it's what you want to hold during times of geopolitical strife. Now, the market doesn't trade it that way. Unfortunately, if you take a look at correlations, Bitcoin is most highly correlated with the NASDAQ. Obviously, the stock index, that is very, very tech heavy. And so the market trades Bitcoin like a tech stock, but in actuality, it's supposed to trade like a hedge against not just monetary debasement, but because it's politically neutral and decentralized, geopolitical uncertainty as well. Kind of the same role that gold plays, right? People jump into gold not just for inflation concerns, but also for geopolitical concerns. You're seeing gold rally and do extremely well right now as a result of that. Bitcoin won't necessarily be the beneficiary of those flight to safety flows just yet, because it's still tightly correlated with tech stocks. I believe that as Bitcoin's market cap approaches the market cap of gold over the next 5-10 years, then you'll start to see Bitcoin trade like it should, like its properties suggest it should, which is this apex risk-off hedge, not just for monetary debasement, but for geopolitical uncertainty as well. And so there's that risk that because of what's going on, further escalations could drive a sell-off in Bitcoin. But that's the first order effect. The second order effect is further monetary easing in order to fund the war effort and huge capital inflows to the United States because we are the world's superpower still. And that means good news for risk assets, right? And so the further monetary debasement and easing that would come, probably both monetary and fiscal, as a result of an escalation and potentially US involvement in a hot war, that would be good for risk assets as a second order effect. But of course, the fear associated with that would be bad news for risk assets as a first order effect. Crypto investors need to understand that Bitcoin and everything else that's associated with it are macro assets. And so the economic strength or weakness, particularly in the United States, needs to be factored in. Now, you talk about revisions. 14 of the last 20 payroll reports as of June were revised lower. But since June, in July, August, and now September, we've actually had 3 reports straight, barring this one because the revision hasn't come out yet, where it gets revised higher after the fact. And so it seemed like for a very long time, economists were overestimating the strength of the economy. And that typically happens during a cycle downturn. You get more misses than beats and lower revisions than higher revisions when the economy is deteriorating. But the inverse happens when the economy starts expanding once again. You start getting more beats than misses. And that's exactly what we've seen over the last 2 months on the payroll report. That's not to say it can't worsen again, but it seems like economic data is now beginning to surprise to the upside. One other aspect of this is the Bloomberg Economic Surprise Index. This is basically just a weighted index that shows, on aggregate, is economic data surprising to the upside or the downside more often? And it just flipped to the upside. It just flipped into positive territory for the first time in 4 months. And so for the first time since June, now we're getting better economic data than is expected. It's surprising to the upside. And so if this can hold, if this can continue moving higher, that means US markets, it's off to the races. We avert recession. The Fed is cutting rates into a growth rebound. Commodities are doing well because demand is very good. Different manufacturing and services reports are showcasing strong consumer demand. And so really it just means it's all off to the races. Recession averted, the Fed lowers the cost of capital. That means it's a field day for risk assets, Bitcoin included. Absolutely, Jeremy. Well, for the longest time, you and I both know the going narrative was that the Fed was going to botch this thing and that we'd be in for a hard landing. I myself certainly ascribed to that theory. But over the last several weeks, what markets have been doing is they've kind of been chopping around a little bit, thinking that the Fed may have actually done this thing successfully. And what I mean by this thing is engineer the cycle for inflation to normalize back down to the 2.5% area where the Fed likes to keep it as its long run average without unwinding the labor market. Obviously, we had a couple of months there where the increase in unemployment rate was accelerating, but now we just had the first month where the unemployment rate actually fell from 4.2% to 4.051% unrounded, which is actually just 1 point away from being rounded down to 4%.
The strength of the U.S. economy is also a critical factor to monitor. Joe notes that recent payroll data revisions have been trending higher, signaling that economists may have been underestimating the strength of the economy. If the U.S. economy continues to surprise to the upside, it could fuel a rally in risk assets, including Bitcoin. The Bloomberg Economic Surprise Index, which tracks whether economic data is beating or missing expectations, has recently flipped into positive territory, indicating that the economy is outperforming expectations for the first time in 4 months. If this trend continues, the U.S. could avoid a recession, and the Fed could lower interest rates into a growing economy, creating a field day for risk assets. With strong consumer demand, rising liquidity, and a resilient economy, Bitcoin is well positioned to benefit from this favorable macro backdrop.
Please like and subscribe my channel.